Hi, I'm James Robinson, and this is my stock pick of the week. The stock pick for the week is Gilead, also known as Gilead Health Sciences. In this report, we're going to look at an overview of Gilead's business model. In future reports, we'll look at the operations, debt, dividends, and wealth creation components of Gilead. Gilead is a research-based biopharmaceutical firm. The company makes a wide range of drugs for the treatment of HIV and AIDS, liver disease, cardiovascular disease, angina, and antifungal medicines, as well as others. The company has 11,000 employees and is based in the Bay Area of California. Gilead was founded in 1987. As of September 13, 2019, the company had a market cap of $85.5 billion. Its revenues were $22.36 billion, profits of $5.9 billion. It had a PE ratio of 14.42. It paid a dividend yield of 3.7%. The company did have $26.64 billion worth of debt, which is more than I would like to see a company have this size have. So looking at the company's scores, as you know, I look at a company in 29 broad areas. 10 of those areas are operating issues, which is how well the company delivers goods and services to their clients. 10 of the issues are financial, which is how well the company deals with debt and risk. And 10 of those categories are management, which is how well a job the company does in returning wealth to the shareholders. This company's grade for operating was about 3.11. Anything over 3 is a buy. It did have a very negative score in R&D. Obviously, as a pharmaceutical company, it's typically going to have a high R&D. The good news is that it gets an actual monopoly as opposed to a consumer monopoly when they come up with a drug that works, and this company has multiple drugs that work and seems to have a healthy pipeline. The grade for management is 3.3, which is very high, which means the company is doing a pretty good job of returning money to us, the shareholders. And the company's grade in financials is 3.0, which I was actually surprised. I thought it would be lower than that. This company has more debt than I like. It doesn't have too much debt, just more debt than I would like. The total score for this company, its GPA is 3.14, which gives it a score of 85 points. That ranks it as the 102nd most well-run of the 885 companies that I've looked at. The reason that I'm telling you to buy it is because it is a very well-run company and it's also relatively cheap relative to the quality of company that it is. So the first question I like to ask about a company is, does it have a consumer monopoly? And in the case of Gilead and typically other pharmaceutical companies, there's not a consumer monopoly, but there's actually a legal monopoly, as their patents are legally defendable. That means that if this company comes up with a drug that works for some period of time, and for quite a lengthy period of time, the company's going to be able to make money off that product. It's expensive to make new drugs, but once you've got a pipeline of drugs, you can solidly predict how well that company's going to do, assuming no new drug comes to replace the drug that our company has. So the company has an actual monopoly as opposed to a consumer monopoly. So is the company solid financially? Well, the company has about $25 billion in long-term debt. That's more than I would like to see. It represents 4.5 years of income, and if you've been following this channel, I'd like to have companies whose income is 4 years worth of income. However, the company has been doing two things that have been mitigating this. They have paid back a significant amount of debt in the last year, and also the income was down, but I expect it to rebound. So the debt is slightly higher than I'm comfortable with, but its income is still 7.6 times debt payment, so it has plenty of money to pay its debts. Does the company reward its owners? Yes, the company pays an above average dividend of 3.7%, and the company's bought back 41% of the company's stock over the last 10 years. So they've done a great job of returning wealth to the shareholders. The company's earnings have gone from 1.03 in 2008 to $4.17 in 2018, which is about a quadrupling. So would I buy this stock at its current level of $66.52? I would highly recommend that you should consider buying this stock.